Okay, good morning once more and welcome everyone to our training today, where we'll be taking a look at Elliot Wave theory. Okay, so I'm sure some of you already know about the Elliot Wave. Some of you, it's an entirely new concept, or maybe you've heard about it and you don't really grasp it. So for this, in this particular webinar here, we'll actually be looking at Elliot Wave in the most basic sense of it, trying to understand what it is, how to use it, how to apply it in your trading, and what it's not actually. Okay, so let us begin. Now, first off, this disclaimer, you need to understand that when it comes to trading in the financial markets, it does involve risk, and you want to ensure you're trading risk capital only. My name is Nana Obin Alexander. I'm head educator and senior market analyst here at Anzo Capital, and I'm a professional trader myself. So this is what I do full time. I was the former head analyst and educator at Gemini Capital Markets and Ivy Markets as well. So yeah, I know my stuff. Now here's what we will be considering today. Just a brief, what exactly is Elliot Wave and who develops this? What is the Elliot Wave theory and the basic principles around it? And then we'll look at some examples to kind of help us understand or see it in the charts, right? And then I would also be explaining what it is and what it's not in terms of how to use it, right? So just stay tuned. If you have questions, as usual, please put your questions in the chat features and I will answer your questions. Now, what is the Elliot Wave theory? Now, Elliot Wave is Elliot is actually somebody's name. The Elliot Wave theory is named after Ralph Nelson Elliot, who was who died in January 1948. Not very important, but the point is, he was an American accountant and author, and he deduced an observation that he found by observing price movement in the chart. So by looking at stocks prices, he was able to observe that there was some sort of repetitive patterns in the wave, in the way the price moves, right? So we all understand that price moves in a zigzag kind of pattern. But then Mr. Ralph observed that the patterns the market makes, or the stock prices made, had a very distinct view, at least from the way he viewed it, right? So these patterns, or these repetitive patterns that he observed in the market, which could be fractalized, right? So I'll explain that in a bit, is something he now started applying to his own trading. I started trading it, developed a theorem around it, and started trading based on it. Now, sure, Elliot Wave has its pros and its cons. It has its disadvantage as well. And some people feel, okay, well, it's not really a system, it's not really a strategy. But the thing is, if you understand what it is about, and then you understand what to look for, you can find out a way to play it out into your own trading system. But what Elliot Wave's theory is not, it is not the full package, in the sense that you don't say you're an Elliot Wave strategy and you just trade just Elliot Wave, in the sense of when this has happened, then you do that. It is just something that gives you a bias to then look for confirmation around where you've spotted already. Okay. Now the Elliot Wave theory is more or less interpreted as follows. The market made 5 waves. So this is called the impulsive move, right? So there's a 5-wave move in the direction of the main trend. So what it's saying is, if the market wants to move higher, if the market wants to go upward, right, the market will make a 5, it does that in some sort of a 5-wave move, predominantly heading in the direction of the trend, right? So this, as you can see here, this will be wave 1, wave 2, wave 3, wave 4, and wave 5. But what you would notice is that predominantly price is heading higher. So the first thing to note is the 5-wave move in the direction of the trend. Now, after that 5 structural move is completed, it is followed by a 3 corrective move, right? So a 3-wave corrective move in the direction against the trend, so against the overall trend. So that means after the market has completed wave 1, 2, 3, 4, 5, it then goes on to make a wave 1, 2, 3, and then before deciding what to do next, right? And most likely continuing the overall trend. So the underlying, the very good point to point out here is the fact that the underlying pattern remains constant throughout the time span of each wave. So what that means is, okay, so I'm going to explain this clearer using another slide. But the point is, even within the structure of a move, you will still find other structures within, right? Now, so here's an explanation of the 5-way move and the 3 corrective waves. So as you can see on your screen here, we have a wave 1. So this is wave 1, right? Then we have a wave 2. Then we have a wave 3, or we have a wave 4, and then we have the 5th wave. Now, after wave 1, 2, 3, 4, 5 is completed, more often than not, you will find a move that seems to break the trend. So here's what I mean. If you were looking at this, so if you're looking at all this from this side, you are seeing a clear bullish market. Why? Because the market is making lows, higher low, higher high, higher low, higher highs, right? Higher low. Now, at this point, the market made a higher low, but then proceed to make a lower high. So you might be looking at this as, okay, are we changing trend? And then the market makes a new low. So it might look like the overall trend itself has changed, but this would just be a corrective wave for the market to then proceed to go higher. So you start looking like, you say in an uptrend, it makes higher highs and higher lows, but then, it doesn't respect it. So the Elliot Wave theorem deduce the market in such a way that the market moves in phases. So there's a motive phase, and then there's a corrective phase. Now, the interesting thing to note is this drawing, like this, what we have in this illustration on our chart here could be a daily chart, right? So this could be a daily chart where you're looking at this, and this is wave 1. But within this wave 1, it could be comprised of wave 1, 2, 3, 4, 5, and then this wave 2 could be corrective wave of 1, 2, 3. So this is the fractalized nature of the market. When I talk about, so it's like the market is like a fractal. For those of you who understand or did mathematics, you'd understand fractals in a sense. But the basic terms is like snowflake effect. So if you break a snowflake, you see a snowflake inside, and you break another snowflake is like an onion. So the more you wrap, you still see more of the same kind. So it's the whole concept of the Elliot Wave theorem, right? So the markets move in an impulsive wave section and then a corrective wave retracement. Now, it doesn't matter what time frame you're looking at, it doesn't matter what instrument you're looking at, you will find such patterns in the market. Now, the basic principles, like I mentioned, is, in the direction of the trend is a 5-way move, and there's a correction against the trend in the form of a 3-way move. So we usually call it the wave 1, 2, 3, 4, 5. And then the corrective wave is labeled wave A, B, C. Now, there's no, it doesn't, just like in the market, it's not going to look like the same. It's not going to look the same every single time, right? And it might not even be clear every single time, but you will find this application in the markets, right? Now, the concept of Elliot Wave takes into consideration, like I mentioned, the fractal nature of the market, where the small pieces, even if broken from the bigger pieces, does in fact look like the bigger pieces. That means the first impulsive wave, so the wave 1 in itself can be its own complete Elliot wave, where it has a wave 1, 2, 3, 4, 5, and a corrective wave 1, 2, 3, or ABC, to then continue upward. So this illustration here depicts that. So if you look at this, right, this is a wave 1. So let me make this line thicker. Okay, so looking at this here, this is a wave 1, 2, 3, 4, 5, and then the corrective 1, 2, 3, right? So this is a full Elliott wave in itself. However, within this wave 1, and you're seeing, look at what we're noticing. It is a wave 1, 2, 3, 4, 5, and then the corrective 1, 2, 3 to then start a new wave. Right, so this is what I mean when I say the fractalized nature of the market, where even within the structure, so even within this wave 1 here on a much smaller time frame, you could still see another wave 1, 2, 3, 4, 5, and then this correction here could be a wave 1, 2, 3 to then continue the overall structure, right? Now, it's not going to be perfect. It's not going to look perfect every single time, because, well, the market, if the market moves exactly the same way every single time, then everybody will make money, and we know that is not the case. But understanding the principle behind and what to, what to watch out for. So sometimes you're seeing an uptrend. The reason why, for those of you who join me in my classes weekly, you would know the way I trade, the way I like to look at the market. And I'm looking at an uptrend, and I'm looking to trade in the opposite direction, or an uptrend, I'm not interested in buying from, a downtrend, I'm not interested in selling, even though the overall trend structure seems intact, right? So it's all based on this principle and the way I look at the market, okay? Now, also, this is another example of the same fractalized nature of the market, where this could be, right? So there could be an Elliott wave 1, 2, 3, 4, 5 into a wave 1, 2, 3, or an ABC to then continue the overall direction. However, within this structure itself, you can see that we have a Elliott wave 1, 2, 3, 4, 5, and a wave 1, 2, 3, or an ABC corrective wave to then go lower. So this understanding is key. It's more, not necessarily, it's very important if you're going to understand the concept of Elliott wave and apply it in your chart. Now, how do you apply this? How do you trade this? Or how do you use this? Because information itself is useless, right? I could sit down here and rant, and preach strategy and explain. If you don't find a way to, if I don't explain a way, or you don't figure out a way to apply it or know how to use it, then in itself, it doesn't do you much good. Okay, so now I talked about what Elliott wave theory is and what it is not. Now, the Elliott wave theory in itself is not, let's begin by what it's not. It is not a standalone strategy. So what I mean is, you don't just look at the Elliott wave strategy and like, okay, so we have completed wave 1, 2, 3, 4, 5, so we must make it wave 1, 2, 3, right? It doesn't work that way. You need some sort of confirmation to do that, to confirm your entries and your exits. So if you don't have a trading plan, you should create one. If you're struggling to do that, go on the YouTube channel, and you'll see a training on developing a trading plan and why you need one. Okay, so the Elliott wave strategy or theorem in itself is not a standalone strategy. You need confirmation to place your trades. You need some other confirmation to confirm those areas you're looking at. So most of the times, Elliott wave theorem goes very hand in hand with like the Fibonacci trading system. So using Fibonacci to identify those levels and try to trade up from them. Now, another important point to note in Elliott wave is this: the wave 3 is mostly, in most cases, is usually the longest. So when we have a wave 1, 2, 3, 4, 5, wave 3 appears to be the major impulsive move. It usually moves irrationally. So for example, if we have if this is an Elliott wave here, so wave 1, 2, right? Wave 3 usually appears to be the longest of all of them. And this is where, smart money comes in and, really push price up. If price were coming down, you have wave 1, 2, and wave 3, mostly longer than most of them. And then you have wave 4 and wave 5, in which case, most times the corrective wave usually comes back up at least to wave 4 to then continue going lower, or maybe in some cases change the trend entirely. But here is where the major impulse is. So where let's say there's a accumulation of distribution schematics around such areas, and then the price comes in, we probably get an order block and price taps into that zone, and then we get this impulsive wave where it seems like the market doesn't give you room to enter into the market. We have those big, huge moves in the market to then form a corrective wave 4 and an impulsive wave 5 to complete the whole impulsive move in the direction price actually wants to go towards. Okay, I hope so far it makes some sort of sense what we're discussing here right now. Okay, now if you have questions, as I mentioned, please feel free to use the chat feature and type in your questions. Now we'll just jump over to the chat and we'll look at some examples on Elliot Wave. Not a lot of, I picked out a few examples. So mind you, I cherry picked these examples for you to be able to see clearly what exactly is going on. Most times or many times you would not find, you might not spot it as clearly as it says explained in this chart. So remember, this illustration shows a very clean wave 1, 2, 3, 4, 5. You might not see that clear, but if you know what to look for, then you would be able to find those opportunities in the market. So let's jump over and look at some examples, and then we would see that in the real market chart. Okay. So until what you know becomes what you do, well, you would always be broke. So you need to start applying what you're learning. Okay. So let's jump over to charts. Let's jump over here to our charts. You should be able to see my screen now as well. And so this is an example. So this is now this is a weekly chart, right? So this is a weekly chart on CAD-JPY, and I already drew the illustration of the Elliott Wave of a completed Elliott Wave theory or strategy, not strategy, completed Elliott Wave in the chart, right? Now, so what you notice is this. Now, this is the weekly chart. So if we were to zoom in, you would see that obviously you could see in this case you have with 1, 2, 3, 4, and 5, and then we had with 1 or an A, B, C corrective move to then proceed to make a 1, 2, 3, 4, 5, right? Now, sure. If we were to take out all of this, right? So let's delete this, right? Let's delete this as well. It doesn't look as clean, except you know what to look for. So it's just like in most cases, if you don't know what you're looking for, even if it's staring right at you in the face, you would not even be able to identify it. And in some cases, it might seem to have to appear different because, you know, a live market is easy for me to go back and show you price of what has happened. As opposed to live chat. So for example, somebody could say, why is this not a wave 1, 2, 3, 4, 5, you know, and then 1, why, you know, this failed, right? And yeah, that could be the case. However, the market is king and we respect it. So let's say, for example, I was looking at this area to be the end of the wave 1, 2, 3, 4, 5, and maybe a corrective 1, 2, 3, and the market decided to go lower. Now, while this could have been it, the market decided to fall down even deeper. So I have to take this into consideration. And then since making this low here, see what the market did. It made a wave 1, 2, 3, completed the wave. Where did that go back up to? Well, it went back up into the wave 4. And then what happened next is, well, the market continued to then make the continuation 1, 2, 3, 4, 5, right? Now, it is not always going to be respected in the sense of the market is not always going to make 5 waves. Sometimes you could see 6 waves. Sometimes you could, you know, you will not be able to see a clear Elliott wave on your chart, in which case you don't want to force that. So what I mean is if you cannot identify a clear pattern, then you don't want to have to start forcing it to fit in, right? Now, like I mentioned, Elliott wave in itself is not a standalone strategy. It's not a strategy you look at and decide, well, I want to trade, you know, you're making decisions based on it. So for example, you're saying, let's assume this is the end of the wave and you're like, okay, now it has to go up. You don't know where the end of the wave would be. You don't know if it's going to be here or here. So once you've identified the structure of the Elliott wave on your chart, what you then need to do is based on your own trading criteria, your own trading plan and how you look to get in and out of trades, you start looking for confirmation, right? So if this were me, for example, around this region, well, what would I do? I'll start looking for confirmation for a reason for price to start going back up. And so here, looking at this now, obviously in hindsight, there's definitely clearly some accumulation here. You could also see some candlestick patterns in the form of a pin bar or whatever, a bullish pin bar. We saw rejections from here, and you know that could then serve as confirmation based on the fact that you're already looking at this to be at the end of the impulse or end of the impulsive wave to begin the corrective wave to then proceed lower. Now, let's look at another example, which in this case, let's just look at the AUD card. So I think that was only 4-hour charts. Now, this is an example of where the market completed the Elliott Wave 1, 2, 3, with 1, 2, 3, 4, 5, completed the ABC, and then did not complete the next one. So you can see here we have an impulsive wave 1, 2, 3, 4, 5, pushing price higher. And then we have a corrective wave 1, ABC, to then start the overall trend. Now, if we were looking at this, we're supposed to expect a wave 1, right? So a wave 1, 2, 3, 4, and then 5. But in this case, notice what happened. Well, the market did not make a fifth wave. It instead changed the trend entirely. But you could see this was a wave 1, 2, 3, 4, 5. And then we have the corrective impulse that appears to have broken the structure, appears to have changed the direction of the trend to then allow the market to continue going back up, right? So the identification of the Elliott wave is just to enable you to be able to then start looking for, have areas of interest in the market to then look for opportunities to trade from. You could, this could be a wave 1, 2, 3. So this would be our wave 1, 2, 3, 4, and 5, and then we could have a corrective wave to then go down lower, okay? And then just like I mentioned, you could see how wave 3 in itself appears to be very imbalanced. The market moved off very aggressively from there. It's mostly the longest wave in the market. It's not always going to be the case. For example, wave 3 in this case wasn't the longest. Wave 4 actually was, or actually wave 5 itself actually was. Okay, so that is in a brief a good explanation of the Elliott Wave theorem and how you can start looking at the market in such nature, based on that, and also understanding that the market is fractal in the way it operates. That means, whether you're looking, so this impulsive wave down here on a smaller time frame could be its own Elliott Wave. Elliott Wave itself happening in them. So let's say we go down to, let me see. So let's say we go down to the 15-minute chart and look at that impulsive wave there. Let's see. But there's no clear Elliott Wave here, but let's zoom in a little bit. No, but looking at this, you could also start using its Elliott Wave theorem itself. It will not always be apparent in the market. And like I mentioned, you don't want to force the trade. You don't want to force, if you can't spot a clear pattern in the market, whether that's Elliott Wave you're trading, whether you're trading candlestick patterns, whether you're trading supply and demand zone, other blocks, whatever it is you're trading, if the pattern itself doesn't appear clear to you, you're better off staying away from it, right? And that's the reason why we plan our trades and then we seek to trade our plan, because that's the only way that we can be consistently profitable in the market. Just like I mentioned earlier, if you don't find a way to start applying what you know, then you'll probably always not be able to grow, okay? So that's, in a nutshell, is the Elliott Wave theorem or the Elliott Wave strategy, and how you can spot it and how you can be looking for those areas where you could expect the markets to react, those points of interest. Use your own system of your own method of confirming your entries, and then look for those areas to trade price from. So I hope you enjoyed the training. If you do, please just leave comments and also let me know. So now I'll take your questions.
Hello, sir.